One of the most concerning unknowns is the different treatment of the two Cypriot banks and what that means for the rest of Europe. What does it mean for the rest of Europe?
Well, there are a number of issues. First, as I said, equal treatment is an important part of European law, and therefore depositors that face a haircut in some banks but not in all might ask whether that was an appropriate application of Cypriot law or European law. The bigger issue is that you have to look at the dynamic implications of what is happening in Cyprus. The first thing that we will see is I think Cyprus will now enter into a very deep recession. There is a huge front-loaded deleveraging in the bank. Of course, a catastrophe has to be averted, but still this impact on the Cypriot economy is going to be huge. That means that not just the banking sector will be not able to transform to perform its key functions. It will also mean that the Cypriot banks will become even more dependent on ECB liquidity lending, because largely the deposits will be drained from the system, and therefore the ECB will have to step up even more than they have so far. So we're seeing some adverse dynamic kick in over the short term, and the question people will ask is, having basically increase the share of money on the table from the country and problems going forward, will that be something that will happen with the next bailout? Now, it's uncertain where that next bailout will be, but clearly it's going to mean a challenge for countries like Spain, who very frequently are rumored about in the market, to make very clear that any bank solution there is going to look slightly different, and they have sufficient funds and capital in the banks to write this out in a different way.
Are you more worried about Spain than you are Italy? And if you are, should we not see a correction in terms of the Spanish banks?
Well, Italy has a difficult political situation, but then it's not unknown for Italy to have a difficult political situation, and they had that through many years in the 90s and in the 2000s. So Italy, in my view, is stronger. If you look at the public debt, for example, yes, it's high with 120%, but the private sector in Italy is not over-leveraged. The corporate sector is pretty healthy. You just saw this morning that the Italian banks were giving a heads up, a sort of thumbs up by the IMF, largely because their lending book domestically is much more intact, given the fact that the corporate and private sector are not over-leveraged. So I think Italy is in a more sound situation. What Italy needs to do, it needs to do the reforms on labor markets and structural reforms to bring their long-term growth trajectory up. The biggest problem in Italy is growth. Where will growth come from? It's also a problem of getting down from a high debt level, but the more immediate, if you look at debt, they're actually moving towards and are in a primary surplus. So even there, the fiscal dynamics look better, but growth is the big issue. Competitiveness is the big issue. That's what they need to tackle.
For capital controls, now we are going to have the details we expect later on this morning on Cyprus. How do you do this within a monetary union? Iceland has done it, Argentina has done it, but this is almost an economic first.
Sure, but most of the transaction will happen through banks. So basically what will happen is they will be registered and they have to be signed on. So if banks do transactions to outside the country, they will have to go through an approval process, and there might be limits to the size of those transactions in a given day, over a month, or over a more longer period. And there is just going to kick in an approval process. So you can technically do it, and they will limit the ability of customers to draw funds out of the bank. So technically it's possible. However, it is unheard of in a monetary union, and again, another first time, which basically seals the country off to a larger extent from the rest of the union. And that again is not a nice thing to do. It's maybe an important step to avoid a catastrophic exit from the euro, which would have had much larger repercussions. But by and large, we're not faced with good choices anymore on these things. We just have to choose between very bad choices, and probably they've taken the least sort of damaging choice on these capital controls, because otherwise you would see a clear bank run and the banks would collapse almost immediately. So you need to limit that to some degree.
Will we look back and actually see as this week on Cyprus as the most decisive moment in the Eurozone crisis?
No, I think so far every moment had this sort of decisive feature to it. I think every time you have a crisis resolution, you come to a bifurcation in the road. You either take the one direction or the other, and having taken that direction, things become past dependent. You create a new precedent, and then of course, like we've seen when there was a change in the terms for the Greek resolution in the third bailout that happened, of course immediately Ireland and Portugal came back and said, we also want a reduction in the interest rate bill, we also want longer terms, and of course, given equal treatment, you have to do it. And that's why every precedent that is created doesn't just have implications for the country where it's created, it has implications for all the other countries where we've already seen solutions. But then if you're being more lenient towards one country, you actually have to be more lenient to the other, and it overall increases the rescue bills. So I think Europe is on a very adverse dynamic here. And really the issue is you need to at some point stop the expectation that things will just continue to deteriorate. Europe is still in a recession. Europe will move sideways at best, and that's not a good place to be in.
But if you look at the markets, it seems they're not seeing it. Are the markets almost fictitious because they're almost discounting everything that's happening? For example, the banking union could be dead in the water before it even arrived, and yet markets are slowly rallying because the central banks stand behind them.
Well, I think the market is understanding that whilst political solutions in Europe take time, take weekend negotiations, Sunday night meetings of finance ministers, and resolutions around and announced usually before the opening of the Asian markets or sometimes the European markets, they have, I think, grown somewhat in the expectation that it'll be all right, finally. Now, it will not happen quickly. You have to have good nerves. There will be cliffhangers. There will be a lot of volatility. It will happen over weeks, and we see risk-on, risk-off periods in the market. But by and large, given the fact that there's already so much rescue money on the table, and given the fact that the ECB has promised to add to it if needed, then I think the market is taking that reassurance that whilst it's not a nice process, and whilst we would have liked different resolutions, they'll find something to do in the end, and they'll keep the project going. My projection has always been European project will continue to be in place. I don't see really a country exiting, but it is a windy road, it is very rocky, and it's an uphill battle.